42 countries. The payment infrastructure underneath a huge share of digital commerce. From the outside, it felt inevitable. Go public. But Stripe chose the opposite. And that decision exposes a conflict that has taken down companies that looked untouchable. In March 2021, Stripe was worth more than any bank in the Eurozone, not more than any fintech startup, more than any bank. In the Eurozone, the number attached to that claim was $95 billion, the result of a $600 million funding round that closed during one of the most liquidity-saturated moments in the history of private capital markets. Sequoia Capital was in the round. Fidelity was in. Allianz and AXA, two of Europe's largest insurance groups, committed capital. Ireland's sovereign wealth fund took a small stake, the first sovereign fund to invest in Stripe at all. The company processed payments for Amazon, Google, Uber, Salesforce, Maersk, Zoom. It operated across 42 countries. It had grown from a two-person experiment launched by two brothers from County Tipperary into the infrastructure layer underneath a significant share of global digital commerce. Patrick Collison, the CEO, was 32. John Collison, the president, was 31. From the outside, everything pointed in one direction. It pointed toward a public offering. The math seemed obvious. The moment seemed engineered for it. The IPO market in early 2021 was operating at a temperature that had not been seen in 2 decades. Companies were going public at valuations that, in any other environment, would have been called irrational. Some were. The SPAC wave was carrying companies with no revenue onto major exchanges. Coinbase listed directly on NASDAQ in April 2021 and opened its first trading day at a valuation above $85 billion. Marqeta, the card-issuing platform, raised over $1 billion in its IPO that June. UiPath, Robinhood, Toast. The queue of large-scale tech listings was long, and the institutional appetite for each one was real. Stripe was not in that queue. John Collison, speaking at a conference in Abu Dhabi in November 2021, 8 months after the $95 billion round closed, with the IPO window still technically open, said the company was very happy as a private company. He added that it felt like they were very early in Stripe's journey. These were not deflections. The Collison brothers had said variations of this for years. Their argument was internally consistent. The pressure of quarterly earnings cycles, the disclosure requirements of public markets, the distraction of managing Wall Street expectations. None of it aligned with what they described as their actual mission, which was to increase the GDP of the Internet. That phrase, increase the GDP of the Internet, appeared in Stripe's communications repeatedly. It was not marketing language. It reflected a genuine conviction that Stripe's role was infrastructural, not extractive. The company had resisted the temptation to monetize aggressively when it could have. It had invested heavily in developer tooling, in documentation quality, in products like Stripe Atlas, which helped founders in emerging markets incorporate companies and access global banking infrastructure. The logic was patient. The logic was long. And in November 2021, that logic still looked defensible. The question of whether Stripe would go public had been circulating for at least 2 years before the Abu Dhabi conference. Bloomberg had reported in September 2021 that the company was in early discussions with investment banks about a potential listing, possibly through a direct listing rather than a traditional IPO, since Stripe did not need to raise capital. Cleary Gottlieb Steen and Hamilton, a major law firm, had reportedly been retained to advise on listing preparations. The infrastructure for a public offering was being assembled quietly, and yet the decision to actually move, to set a date to file an S-1 to begin the roadshow, was never made. What made this period unusual was not that Stripe was hesitating. Many large private companies hesitate before going public. What made it unusual was the scale of the opportunity being left on the table while the hesitation continued. In the first quarter of 2021, the Renaissance IPO ETF, which tracks newly public companies, had returned nearly 20%. Retail participation in equity markets had reached levels not seen since the dot-com era. The Federal Reserve's benchmark interest rate sat between 0 and 25 basis points, a level it had held since March 2020 and would hold through most of 2021. Cheap money was inflating asset prices across every class. Companies that went public in that window captured those conditions in their balance sheets. Coinbase raised approximately $1.5 billion in its direct listing. Robinhood raised nearly $2 billion in its IPO. The companies that moved, even those that stumbled in aftermarket trading, left the process with permanent capital at historically elevated prices. Stripe did not move. The internal logic remained what it had always been. Public markets were a distraction from engineering. Quarterly reporting created perverse incentives. The company was profitable or near profitable and did not need the cash. And there was something else, less stated but present in the record. The Collison brothers had watched other tech founders lose operational control after IPOs, watched boards shift, watched short-term thinking creep into product decisions. Going private meant retaining the ability to think in years, not quarters. That calculus made sense. It had made sense in 2018. It had made sense in 2019 and 2020. By late 2021, the calculus had not changed. But the environment had begun to. In November 2021, the same month John Collison was speaking in Abu Dhabi, the Federal Reserve signaled for the first time that it would begin tapering its asset purchase program. The language was cautious. The markets absorbed it without panic. But the signal was real. Inflation had moved above 6% in the United States. The era of near-zero interest rates, which had been the single most important variable inflating private market valuations for more than a decade, was approaching its end. What followed in 2022 was not a correction. It was a repricing. The Fed raised rates 7 times that year, moving the benchmark from near zero to above 4% by December. Growth-stage technology companies, which are valued primarily on future earnings discounted to the present, are acutely sensitive to interest rate increases. As the discount rate rises, the present value of future cash flows falls. The effect on paper valuations was immediate and severe. Stripe's $95 billion valuation had no public market to anchor it. It existed on paper, in the terms of private funding agreements, in the coverage of financial press. When public fintech comparables began to fall 30, 40, 50% from their 2021 highs, Stripe's private valuation carried no mechanism for automatic adjustment. The number stayed on the page, but everyone in the market who could read a comp table knew what it implied. The decision that had seemed patient and principled in 2021 was becoming by degrees a constraint. The most direct cost fell not on the Collison brothers, but on the people who had built the company with them. Stripe had used restricted stock units, RSUs, as a core compensation tool for years. This was standard practice among high-growth private companies. RSUs are grants of equity that vest over time and typically convert to liquid shares upon a qualifying liquidity event, usually an IPO or an acquisition. For Stripe employees who had joined in the early and mid-2010s, those RSU grants had accumulated into significant paper wealth. The $95 billion valuation in 2021 had made that paper look very valuable indeed. But RSUs do not stay on the books indefinitely. They carry expiration windows. And for Stripe, which had been private for over a decade without a liquidity event, those windows were beginning to close on a large cohort of early employees. The technical complication was specific. When an RSU's expiration date is modified, extended rather than allowed to lapse, the Internal Revenue Service treats the modification as a deemed distribution. The tax liability is triggered immediately, regardless of whether the employee has received any actual cash. For Stripe employees holding large RSU grants, the expected tax bill was enormous. A leaked pitch deck circulating in early 2023 put the aggregate tax obligation for affected employees at approximately $3.5 billion. Stripe needed to find a way to fund that obligation, or watch a generation of long-tenured employees face tax bills with no liquid shares to sell. In March 2023, the company announced it had raised $6.5 billion in a Series 1 funding round. The announced valuation was $50 billion. $50 billion, not 95. The reduction was approximately 47% from the March 2021 peak. J.P. Morgan was involved in organizing the raise. The round was structured partly to fund a concurrent tender offer that would give affected employees the ability to sell at least some shares and cover their tax exposure. Stripe said explicitly that it did not need the capital to operate its business. The fundraise existed in large part because the IPO window that had been wide open in 2021 was now effectively shut, and the internal consequences of that closed window had become impossible to absorb without outside capital. This was the financial cost made concrete. Not abstract opportunity cost, not a theoretical comparison against an alternative timeline. A real capital raise, at a real 47% discount, conducted under real pressure from real tax deadlines. The decision that cost billions, measured not in foregone proceeds but in the actual terms on which capital finally had to be obtained. The psychological effect inside the company moved in parallel. Stripe had spent years recruiting on the premise of a coming liquidity event. Compensation packages had been structured around it. Engineers and product managers who had turned down other offers, other companies, other RSU grants, offers that might have included more cash, had done so partly on the belief that Stripe's public debut was approaching. When the valuation was cut nearly in half and the IPO remained absent from any credible timeline, the calculus of those decisions became difficult to revisit. Stripe's headcount had grown rapidly through the 2020 and 2021 expansion. In late 2022, the company laid off approximately 14% of its workforce, roughly 1,000 employees, citing overhiring during the pandemic growth period and the need to align costs with the new operating environment. The layoffs were acknowledged in a memo from Patrick Collison that described the hiring of the prior 2 years as a mistake in judgment. The internal share price, reflected in secondary market transactions, fell significantly from its 2021 implied levels. Employees holding unvested grants watched the numbers move in a direction that had not been part of any hiring conversation. Some left, others stayed and waited. The waiting, by 2023, had become its own kind of answer to a question no one at Stripe was asking publicly. Meanwhile, the peers who had gone public in 2021 were operating in a different financial reality. Coinbase, despite a brutal 2022 in which its stock fell more than 80% from its listing price, had raised roughly $1.5 billion at its 2021 listing. That cash did not disappear when the stock fell. It stayed on the balance sheet, available for operational use, for hiring, for product development, for weathering the crypto winter. The capital raised at peak conditions provided a buffer that the market correction could not retroactively eliminate. Marqeta, which went public in June 2021 at a valuation above $15 billion, similarly locked in capital at conditions that would not recur. Its stock also fell sharply through 2022. But the liquidity event had happened. Employees had received shares they could sell. Early investors had partial exits. The company's public currency, its stock, could be used in ways that private equity could not. Stripe had none of that. It had operational cash flow, which was strong. It had brand, which was extraordinary. It had market position, which was defensible. What it did not have was the permanent capital that a 2021 IPO would have generated at $95 billion terms, or the liquid equity that employees had been told, implicitly if not explicitly, was coming. The opportunity cost is not entirely calculable, because the alternative timeline does not exist. A $95 billion IPO in 2021 would have been one of the largest technology listings ever conducted. The proceeds, even in a direct listing structure where the company itself raises limited capital, would have established a public share price from which secondary offerings, acquisitions, and employee compensation structures could have been built. Stripe was considering a direct listing precisely because it did not need the money. The irony is that the company that did not need the money in 2021 was forced to raise $6.5 billion in 2023 at terms it would not have accepted 2 years earlier. The decision that cost billions was not reckless. It did not emerge from ignorance of how IPO markets work or from indifference to employee compensation. It emerged from a set of beliefs about the relationship between public markets and long-term product quality. Beliefs that were intellectually coherent, widely respected in the industry, and in the specific conditions of 2022 and 2023, operationally costly in ways that had not been fully modeled. There is a version of this story in which the Collison brothers were simply unlucky. Interest rate cycles are not predictable with precision. No one in early 2021 knew exactly when the Fed would move, or how fast, or how far. The argument for staying private in November 2021 was not obviously wrong. The market had not yet broken. The correction was still months away, but the structure of the risk was visible. Private market valuations had been stretching for years on the back of zero-rate conditions. The companies going public in 2021 were doing so at multiples that assumed a continuation of those conditions indefinitely. The risk that rates would rise, and that growth multiple valuations would compress when they did, was not a secret. It was being written about. It was being modeled. The question was never whether it would happen. The question was when. And the window, once open, closed faster than most models had predicted. By 2024, Stripe had returned to a recovery trajectory. Revenue growth was strong. The company reached profitability on an adjusted basis. Its payment volume was growing at rates that few competitors could match. The business itself, the infrastructure, the developer relationships, the product suite, remained formidable. A new valuation benchmark emerged in secondary markets, settling in ranges above $60, then $70, then $90 billion as the macro environment partially stabilized and growth assets partially recovered. By February 2026, the picture had shifted again. Stripe announced a new tender offer for current and former employees, backed by Thrive Capital, Coatue Management, and Andreessen Horowitz. The valuation attached to the transaction was $159 billion, the highest in the company's history. The company reported that businesses on Stripe had processed $1.9 trillion in total payment volume in 2025, up 34% from the prior year. That figure represented approximately 1.6% of global GDP. The business had grown into the valuation, and beyond it. Stripe was still private. No IPO had been filed. No S-1 had been submitted. No roadshow had been announced. The $159 billion figure existed in the same place the $95 billion figure had existed 5 years earlier. In a private transaction, in a funding agreement, on paper, the employees participating in the tender offer would receive some liquidity. The investors backing the round would own a stake in a company processing nearly $2 trillion annually. But the public markets and the permanent capital and price discovery they would provide remained absent from the timeline. John Collison, in the company's 2025 annual letter released in February 2026, described Stripe's programmable banking services as now powering more than 5 million businesses, including 90% of the companies in the Dow Jones Industrial Average and 80% of the largest technology companies. 25% of all newly incorporated Delaware corporations were using Stripe. More than half of the companies on the platform were based outside the United States. The numbers described a company that had, in operational terms, fulfilled the mission the Collison brothers had articulated at the $95 billion valuation. The GDP of the Internet had grown. Stripe had helped grow it. And yet the question that had been deferred in 2021, deferred in the Abu Dhabi conference room, deferred through the rate cycle, deferred through the down round, deferred through the layoffs and the RSU tax crisis and the secondary market discounts. That question was still deferred. At $159 billion in private valuation, Stripe had become something the venture capital industry had rarely encountered at scale. A company too large for the private market structures it was still operating within, and still without a clear date for leaving them. The tender offers that had replaced the IPO as a liquidity mechanism were functional but limited. They allowed some employees to sell some shares at some price on some schedule. They were not public markets. They did not produce continuous price discovery. They did not give the company a traded currency for acquisitions. They did not complete the transaction that employees, early investors, and the broader capital markets had been anticipating for the better part of a decade. Whether the decision to stay private through 2021 will ultimately be judged as a mistake depends on a frame of reference that the historical record has not yet closed. The business survived the correction. The valuation recovered. The company is larger, by every operational measure, than it was at its peak private valuation in 2021. But the employees who held RSUs through the down round, who watched their paper value cut in half before recovering, who waited through years of deferred liquidity events for a public market that still had not arrived by early 2026, their experience of that decision does not resolve cleanly into either vindication or failure. The records from that period are in the funding agreements, The leaked pitch decks, the tender offer announcements, the annual letters. They will remain there,